Hi, welcome back to the channel. You know, sometimes I get these questions in the comments and questions in email, and if there's enough questions that have to do with the same thing, then I address them right here on this channel because I want you to get better if you can get better. And so I got a question from John Tram. Thanks, John, for your question. Can you do covered calls on an ETF like QQQ? What about a leveraged ETF like TSLL? Well, let me talk about both of those. QQQ is the NASDAQ ETF. It's a broad ETF, exchange traded funds, which covers a lot of different tech stocks. And when you get an ETF, you are spread out your risk. You're spreading out your risk over lots of different stocks. So generally, your volatility will go down. Talk about that in a second. On a leveraged ETF, there's a leveraged ETF like TSLL, which is a Tesla exchange traded fund, but it multiplies the movement of Tesla by 1.5. Let's use percentage. If Tesla moves 1%, it'll move 1.5%. So it moves both ways, right? It's not just, it goes against you if it goes down. It's not just always bullish. So you have to be real careful. These are directional ETFs, these 1.5. So if you're right, you get a little bonus. If you're wrong, you pay bigger, right? And so we'll talk about both of those. All right, here we go. Let's start with the QQQ, and the market's closed right now, and that's why you're not seeing a lot of data painted in here. But as of the close, the ETF was at 390.67, something like that. Let's call it, 390.70, somewhere around there. And so to make this an easy thing to look at, we'll look at the 391s, just slightly out of the money, by 33 cents, something like that. So we're going to look at the 391s. So you're going to buy the ETF, the QQQs, at 390.67, and you're going to sell the 391 calls that expire in 13 days. QQQs have less volatility because the risk is spread out over all the different stocks. What that means, though, is if you can get the probabilities in your side, which is what we always talk about in the cash flow machine, the right stock in the right market at the right spot on the chart, and then we squeeze the juice. If you can get all four of those things working at the same time, then you have a higher probability of being successful. So right now, and this is not a recommendation, this is only education. Remember that, it's information so you can get better. Right now, the market is green. Right now, the QQQ is green. Right now, Tesla is green. So when we analyze all these things, we've got some of those probabilities in our favor. Whether it's at the right spot on the chart or not, I'll leave that up to you because that's a deeper discussion. I just want to give you the numbers, and I want to show you the numbers. Now, we've got a 13-day QQQ call that we're going to be selling against our QQQ position. So let's say we go out and buy it, 390.67, and we sell the calls. Well, here's what that looks like. Okay, our strike price is 391, and let's just do 1,000 shares. It expires in 13 days. Let's look at the calculations. The basis on this is we reduced our cost from 390.67 down to 386.30. We get $4.37 in juice because it's out of the money. You always get all the juice. And by the way, the juice is always yours. We always get the juice. And so on this trade, we're going to make about 1.1%, about $4,370 on this. But it's a big position cost. It's $386,300. So if you annualize it, in other words, if you can do this over and over again, and there's no guarantee, this stock has to go to 391 for you to maximize the return. But if you can do this over and over again, this is a 13-day trade, but if you do it over and over again throughout the year, you end up making an annualized return of 32%. Okay? Remember that number, 32%. So that's on the QQQ. It's got a bit lower volatility. It moves a little bit less. The stock chart looks good. The pattern looks good. All the tailwinds are good. So there's a good probability that you make this 1.1% in 13 days. Is that good? I'll leave that up to you to decide. But remember, annualized 32% is the return on investment. And I use the annualized because it helps us analyze apples to oranges, right? If we do a different trade, which we're going to do in just a second, I want to show you what that looks like. Here we go. This is the TSLL, the 1.5 times Tesla. It's 1384 roughly as of the close. It's up 6 cents. So it's around 1380, let's call it. And then we're going to go, these are 1384, we're going to go just slightly out of the money and to the 14s and get 55 cents for those 14s, okay? So 55 cents. This is a 10-day trade. This expires in 10 days. And so it's a little bit different time calculation, but let's see what those calculations look like. So let me first of all throw out a disclaimer that I just don't like trading things that are $13. Like, to me, that's almost penny stock stuff. That's foolish. I don't agree with this trade. I don't think people should do this trade, but somebody asked me a question. I'm just going to do the analysis of it. But I like stocks that are over $100. I like stocks that are institutionally supported. I like ETFs if they're, I don't really like ETFs if I'm being honest, but if you're going to have an ETF, make sure it's a liquid ETF, not some of these fly-by-night ETFs that trade, 1,000 shares a day. Make sure it's a liquid ETF. This one is, but it's 1380, which means that a couple cent move is a lot of percent, right? A couple cent move on a $100 stock is not much of a percent, but down here it is. And that cuts you both ways. But let's do the numbers on it anyway. So the underlying ETF stock price is 1380. Okay, so that's our position. We're going to get 55 cents for selling it. And our strike price is just out of the money. It's at 14. Now, since it's so cheap, we're going to do 10,000 shares, and it's a 10-day trade. Now, I say it's a 10-day trade, but normally once I get into a position, I stay into it and I just keep selling the options against it until I'm done with the position, which is a long time. I've been in Tesla for 3.5, almost 4 years now. So, but anyway, be that as it may, let's take a look at the calculations. Here the calculations are the basis has gone down from 1380 to 1325, so that's your break-even point. The juice is 55 cents, as we already talked about, and that's about 4%. I mean, that's because it's so cheap. That's a big percent, right? And so when you calculate it annually and you look at it, it's got an annualized return on investment of 152%. Now remember, the QQQ that we talked about, the less volatile one, was 32% annualized. This is 5 times that roughly. It's 152%. So you end up making $5,500 on this trade for 10 days, less than the 13 on the QQQ. So it would look like the numbers show you that this is a better trade. I don't know if it's a better trade or not. I'm just telling you that things are different when you've got multipliers of 1.5, when you've got different volatilities. Tesla is a volatile underlying instrument, and that's the only thing this is based on. That could be good if it's going up, could be bad if it's not. So I'm just giving you the kind of the lay of the land on John's question about, can you do this on ETFs? What I've noticed is that ETFs are a lot harder to make money with because they don't move a lot, because sometimes they have dividends and you get called away on them. There's a lot of hair around, doing ETFs and some of these cute little instruments like the TSLL. But you can do them. They're out there. There's ways to do them. I just showed you, and they're not bad either. 32% a year is pretty good. But remember, that 32% means it's got to go above the strike price every time for you to get that full amount. Anyway, just wanted to give you a quick lay of the land based on John's question. And by the way, it's not just his question. I get this question all the time, so I figured I'd address it. And I hope that helps you. See you on the next video. Take care.
Hi, Mark Yagi here, wealth architect and author of this book on my covered call investing system called the Cash Flow Machine. Listen, what you just saw is just one part of creating reliable income of 2 to 4% a month from the stock market. But if it were that easy, then everyone would do it, right? If you want to learn how I create investment income the right way, then you need to learn and have a system with rules and what-if strategies so that you can learn what I do when the market goes against me, what I do when the stock goes against me, how to adjust my trade so that it's always in a winning position, how much to risk, how to build a multi-million-dollar portfolio that creates income of $10,000, $20,000, or $30,000 a month in semi-passive income. And best of all, the whole cash flow machine system takes less than an hour a week to implement. Just go to cashflowmachine.io to learn more, or click this link for more videos, masterclasses, and free resources. See you there.